Consider three different investments, all of which offer the same 10% return. So let's assume you invest £1,000 with a 10% annual return. After 1 year, your investment would go to £1,100, making a profit of £100. If you invest £10,000 with the same 10% annual return, your investment will grow to £11,000 after 1 year. Again, the same 10% return, but just a larger investment. So your profit is £1,000. And lastly, looking at the £100,000 investment with the same 10% annual return would grow to £110,000, resulting in a profit of £10,000. So the investment, the risk, and the period are all the same in all three cases. But the amount of money invested, and as a result, the profit is different. Why is that? It's because the larger the amount you invest, the bigger the potential returns. As you increase your investment, your total returns grow proportionally, which means you're able to build wealth at a faster pace. The reason I share that example is because, as it turns out, your first 100K is often the hardest milestone to reach in your investing journey. You may have heard Charlie Munger's famous quote, "The first £100,000 or dollars is tough, but you've got to do it. I don't care what you have to do. Find a way to get your hands on £100,000. And after that, you can ease off the gas a little bit." So why is it so tough in the beginning, but then things get easier? The best way to explain this is by looking at another example. So let's say you invest £300 every month with an 8% annual average return for the next 40 years. You can see that for many years, the gains aren't all that impressive, to be honest. I mean, after the first 5 years of investing £300 every single month, you would have made a total of £22,490. It's nothing serious, but nothing to ignore either. After 10 years, you're still not anywhere close to your first £100,000. Here, you reach a net worth of £55,000. It's not until year 14 to 15 that you get to that exhilarating first milestone of £100,000. That's quite a long time to get there. And as you can see, half of this is due to interest alone. But here is where things start to get really interesting. To get to the second milestone of the next £100,000, the time period shortens drastically. By year 21, your portfolio is worth over £200,000. It took you less than half the time it took to reach the first 100K. Only about 6 years. That's because the 8% return is based on a larger amount of money. And what's even more interesting is that you would have earned substantially more in interest than what you actually contributed. That's because you're earning interest not only on the first £100,000 you've already saved, but also on the interest that the initial £100,000 has accumulated. As a result of this compounding process, the time it takes to reach the next £100,000 reduces to only 4.5 years. After that, it will take just over 3 years. And you'll see that the time it takes to earn each additional £100,000 decreases as you have more money working for you. And then by year 40, you have made over £1 million, with the final £100,000 taking you only 2 years to earn. However, what's incredibly fascinating is that you've made more than 85% of your wealth from interest alone. You only put in £144,000, and the rest is all interest. As you saw, the hardest and the most time-consuming part is often at the beginning, because you don't have compound interest working for you. So you have to do a lot of the heavy lifting yourself. That's also why a lot of financial content for people at the start of the journey is based around optimizing every penny and saving as much as possible. So the reality is that until you reach your first £100,000, it may feel like you're not making any progress. However, it's the patience and consistent investing of small amounts that, when combined, will help you reach that first 100K. Once you reach that, every success then adds up pretty quickly, and the further into the well-building process you go, the easier it gets. The bottom line is that there are really two key factors at play here: the scale of your capital and compounding. But there is a third aspect that is often overlooked, and it's why investing can feel complicated. While I mentioned the importance of having patience and consistently investing over the long term, many people struggle with this because they don't know how to manage their emotions, which is the third and most crucial factor. This emotional side of investing is often underestimated, and there are times when your feelings can significantly impact your decisions. However, once you understand these three facts, investing will change completely. and you'll be able to stick with it, reach your first 100K milestone, and then continue moving forward without worrying about losing your money. The first fact is that you don't need to know 99% of the information about the stock market. The problem with investing nowadays is that we're presented with way too much information about the stock market. What's the market outlook for the next year? What are the best stocks to invest in? Is the market going to crash? And so on. All of this information affects our expectations about investment returns and influences our decision-making process. We might think that staying updated and learning about everything happening in the investment world will make you a better investor. But in reality, that's simply not true. In fact, we don't even need to know that much about investing to be able to build long-term wealth. All we have to know is that the stock market moves up and down for all kinds of reasons beyond your control, and we shouldn't react every time that happens. As long as we hold a low-cost, diversified portfolio, there is really not much else we need to care about. In 2013, investment company Fidelity conducted a study examining how their customers' investments performed over the past 10 years. They discovered that the investors who fared the best were those who were inactive, had their assets frozen, or had passed away, essentially leaving their investments untouched. In other words, the most successful investors were those who had no control over their investments, which suggests that the best strategy for building long-term wealth is to simply do nothing. It might seem boring, but the truth is that the second fact you need to understand to reach the £100,000 milestone is that successful long-term investing is meant to be boring and simple. Long-term investing doesn't mean daily trading. It's not what you see in The Wolf of Wall Street. Lots of yelling on the trading floor while trying to make a profit. Trying to make money like this is not investing. It's more like gambling. The problem is that apps like Free Trade and Trading212 make it very exciting to invest. They hook you by offering a free share when you download their app and use these cool, flashy interfaces and sound effects that are meant to encourage people to trade. But while you might make some quick profits in the short term, over the long term, you're almost guaranteed to lose money. Don't get me wrong, this is a lot more exciting than auto-investing 10% of your income in an index fund every month. But if you want investing to be exciting, then you're doing it wrong. In reality, successful long-term investing should be boring. Nowadays, the sheer number of index funds, ETFs, and stocks available can make you feel like you're missing out on big gains if you don't invest in a certain fund or stock. And the investing industry is well aware of this and promotes the latest hot stocks and portfolio strategies to capitalize on that fear of missing out. After all, they profit by making you feel like you need to jump on every trend. But as I mentioned, the truth is that you only need 1 or 2 quality index funds in your portfolio to build long-term wealth. That's it. The final thing you need to understand to reach the £100,000 milestone successfully is that stock market crashes, corrections, and even minor dips are completely normal. No one likes seeing their investment accounts in the red. However, the truth is that market fluctuations happen more frequently than you might expect. On average, since 1980, the stock market has experienced minor corrections of about 5%, approximately 4.5 times each year. In that same period, more significant corrections of 10% or more have occurred approximately every 1.2 years, while major crashes of 20% or more have taken place every 5 to 6 years. In fact, this chart shows that even though the market experienced a double-digit decline in 22 of the last 42 years, it ended the year with a positive return 14 times out of those 22 instances. So what does that tell us? It tells us that market fluctuations are part and parcel of investing. Even if the market drops as much as 40% in a single year, the likelihood is very high that it will recover by the end of that year or in the following years. So in theory, all we have to do is ignore the volatility and continue making our contributions month after month and let our money compound over time. However, this is of course much harder in practice, which is why it's helpful to think about these market declines as the price we pay for successful long-term investing. Now, one major reason many people struggle with their investments is that they start investing without first building an emergency fund. This is a huge mistake, and in my opinion, no one should begin investing until they've built a cash reserve to cover 3 to 6 months of expenses. So watch this video to learn about the best and worst places to keep your emergency fund while investing. See you there.